Hey folks, thanks very much for tuning in. It's Dave Burrows, President and Chief Investment Officer here at Barometer Capital Management. I want to thank everybody for taking the time to tune in today. Sorry for getting off a couple of minutes late, but happy to have everybody on today. It's been a busy week. Markets continue to progress. We've had additional inflation data here in Canada on top of the inflation data we saw last week. We saw some good PPI data. And of course, we've got the Fed meeting coming up, which likely is the last of the rate hikes in this very strenuous Fed rate hike cycle that we've been through. Let's kick off the top and just take a look at health of markets from a big picture perspective, drill down a little bit into the leadership. The reason we do these meetings every week is to look for change, to look for signs that either we're on the right path with portfolios and we're structured the right way, or that we need to make change. And so that people, frankly, recognize that we do what we say we're going to do and continue to scrutinize the portfolios. So off the top, we continue to believe that we're in a structural bull market. We've been above this rising 200-week moving average since 2013. We've tested it a couple of times, but clearly, we remain above. October, we tested the low end of the band. Here we are pushing back toward the old highs, now only down 4.6% since the beginning of the bear market at the end of December 2021. And along the way, the market has digested a lot. It's digested a global central bank tightening cycle. It's digested some very difficult, hot inflation data. We've dealt with geopolitical risks from China, certainly geopolitical risks from Eastern Europe, Ukraine, but the market is digesting it. It's really important to remember that when we own a portfolio of stocks, we do not own the economy. We pick our spots. We find those areas of the market that we think are going through some kind of positive structural change. We don't own governments. We don't own government debt, really. We're not big bond holders. We own corporations and we own other assets that we think can be revalued. So things continue to sort of heal. The S&P put in its low in October, which made a series of higher lows since then. The volatility has been coming out of the market. You can see that the moving averages that all were moving sharply lower as recently as February slowly made their turn. And now we've got the 200-day, the 150-day, the 50-day, the 21-day, and the 9-day moving average, all moving in unison higher. We're above all of them. And we're at 15-month highs for the S&P. So at this point, we have a fairly clear uptrend. Can it pull back? Sure, it can. Last area of resistance we broke is back from August of last year. And we did pull back and retest it from sort of the top end and now have moved nicely higher. You can see what a great move we've had really since the month of June began, end of March. S&P's been moving smartly higher. Now, over the course of the year, it has been that the very biggest companies in the S&P brought the lion's share of return. We spent a lot of time talking about the fact that the market had to broaden out. We need to see leadership other than the top 7 stocks in the S&P. We know that the NASDAQ 100 is about to rebalance, in fact, because of the very heavy concentration of the biggest companies. And we know a healthy market is made up of one where more and more companies participate in a rally. So we don't want to get too caught looking at the index itself. We want to look underneath the covers to see what's happening internally in the market. We know the Dow Jones Industrial Average this week, and in fact today, broke out to a new high. It's been accelerating since the beginning of June. In fact, it's up just about 6.6% since the beginning of June. That's a pretty sharp move higher. This had been lagging, but like the S&P has been putting in a series of higher lows. When we look at the TSX index, S&P TSX, same picture. Relative performance has been weaker, but again, sharp move higher since the middle of June. So we're seeing healing going on across a bunch of markets. One of the best ones to watch for us is the Russell 2000, made up of mid-cap companies in the US. You can see that since May 31st, it's up 14.6%. That's a broadening. That's strength in the market reaching into other groups, and dragging other companies along. That's buyers being prepared to go beyond those 6 or 7 companies they are all convinced are the best companies in the world. And frankly, it's probably also saying that the economy is in better shape than what some of the most feared economists believed. We've talked a lot about how global stocks have been doing better. The Japanese index continues to improve, but it's the very beginning of a new bull market. It's been in a structural bear market since 1991, 30 years. So the fact that it's making new highs is a good thing, not a bad thing. We know that when the S&P broke out in 2013 above the highs that it had put in place in 2013 years earlier, that was a beginning of the bull market that goes on today. And certainly good value there. Warren Buffett has been a significant buyer of Japanese equities over the course of the last 6 months. India, where there is significant change taking place, where there are lots of reforms taking place on ethics. Market broke out in 2021 and consolidated while the Fed and other central banks tightened their policy. But like many other groups of stocks in the market, since the market started to sense the Fed may be close to done, the market is now looking beyond the tightening cycle, and you've seen a nice reacceleration. We've seen an acceleration in the Mexican stock market after a long period of underperformance. We've seen even a strong pickup in support in the Eurozone. Eurozone markets in the past week making 52-week highs. Emerging markets out of favor since 2008 are putting in a nice bottom. October the 17th, we had a low, and again, a series of higher lows as the moving averages all have based out and slowly hooked higher. So across the equity asset class, not just in the US, not just in Canada, but globally, we are seeing a broadening of the equity advance. And interestingly, this has been against a backdrop where investors, sensing danger, have been pulling money out of equities into bonds and into money market. Now, moving away from equities for a second, we talked a lot about the bond market and the fact that we've moved from a disinflationary environment to a reflationary environment. 10-year yields that have been moving lower since 1981 put in their crescendo low at 40 basis points in March of 2020, have moved higher from then. We've traded as high as about 4%. We're sitting at 4.78. Those yields have been consolidating, but the moving averages for interest rates are now hooking higher, meaning it is likely this is a more sustained move higher. Now, it doesn't happen all at once. We know that last time the rate cycle turned in the early 50s, it moved higher in fits and starts for about 25 years. Now, looking at positioning, again, this is really important to understand. What have people positioned for? People have positioned for a recession. Bond holdings are as concentrated as they have been at any time since the lows in the market in March of 2009, when all of us worried that the world was coming to an end from a financial standpoint. My guess is if risk accepting parts of the market are performing better, these could wind up being a source of cash. If you think about what a bond investor's been through, the aggregate bond index from the top was down 22.2%. And yeah, it rallied a little bit over the last number of months, but frankly, that advance failed. And we sit now below a bunch of declining moving averages, meaning bond prices, easiest path forward is lower. And bond investors are losing money year to date. Long treasuries, TLT, down about 3.6% so far this year. So when we look at asset classes, we have to understand the structural backdrop. Stocks relative to bonds are a more attractive asset. We've been through a period of tension where investors tried to sort out where their money should be. And it looks as though the weight of evidence is money moving into stocks and out of bonds as we make new relative strength highs versus the bond market. Now, I think that this is a really important point to push on. And for those that haven't been on in a while, I want to touch on this. When rates started to rise in the early 1950s, a lot of people think that stocks can't go up while rates are moving higher. And while it may not be the same stocks, certainly they can. Now, During a period of falling interest rates, you get your coupon on the bonds and you get some capital growth. So when interest rates were falling from the late around 1918 through 1940s, you got your coupon and you got some capital growth. And as a result, stocks versus bonds in that period had about a 1-to-1 ratio for return. You got your coupon plus some appreciation, just like in stocks, you get your dividend plus some appreciation, even return. When interest rates started to rise in the early 1950s, we've talked about this now for a couple of years. What happened? Well, stocks started to accelerate relative to bonds. Stocks went up 5-for-1 between 1945 and 1981. 5-for-1 stocks versus bonds was the return. 10.2% a year for stocks, 1.95% a year for bonds. In fact, if you just take the period from 1950 to 1966, where rates went from 1.4 to 6.6%, the S&P went up 15% a year. Now that's a total of capital growth plus dividend. Bonds gave a return of 1.6. It was their coupon less some losses as rates went higher. And that roughly equaled inflation. That's without paying any tax on that return. So we truly believe that over the period in front of us, not in short periods, but in longer periods, stocks will well outperform fixed income in a reflationary world. And this is one of the reasons that we're anxious to make sure that we are positioned well in the sectors that are going to participate. Now, moving away from stocks and bonds, commodities. Now, commodities, we know we're in a bear market from 2008 through 2020. They made a nice turn and had a rip-roaring rally between 2020 and 2022. 6 months into the bear market in stocks, commodities started to pull back. That was on the back of the Fed's tightening cycle. Now, given how much the Fed has tightened, if you were in the camp that we were headed to a significant tragic recession, you would think that commodity prices would collapse, but really they haven't. They pulled back to the very long-term moving averages. And in the last 2 months, hooked higher out of that consolidation. So let's look at that under a microscope. This is something that we've waited for a long time. It felt like a long time. While this overbought nature and relative strength was worked off, we've seen relative strength turn back higher again versus stocks. And you've seen a turn in prices for the broad-based commodity index. Well, that's important because we've seen this in a lot of different places. We saw it in agricultural commodities, a reacceleration higher. We saw it in uranium producers, an acceleration higher. We've seen an acceleration in oil prices as the Saudis and the Russians have cut production, and the US has falling production now coming out of shale oil regions. So oil positioning is in the 5th percentile. Investors got so cautious, worried about recession, and hedge funds got so aggressive at making bets against oil, thinking that a slowdown in the economy would push back demand, that we now are in a position where we have positioning in investment portfolios as low as they've been in several years. And we know it doesn't stay there. If prices start moving higher, they got to reposition. So you got very late positioning, oil prices moving higher, inventories coming down, production coming down. This is a recipe likely for some gains. Moving to currencies. I know that this is a broken record, but since October, we've seen a series of lower lows and lower highs in the US dollar versus the basket of currencies, euro, yen, and British pounds. This really accelerated over the last few weeks. And now we've taken out all of the technical support. So my guess is the distance from top to the first low, and then this congestion likely means we have another measurement lower, which is very supportive of global stocks and commodities. So the market's like a quilt, pieces fit together. And you got to continue to see things unfold as you would expect. But the pieces continue to confirm this view that we've gone through a major shift in the market, disinflation to reflation. Now, some data from this week. One of the concerns obviously has been inflation. In the last week, we saw US CPI data come in light. The actual data came in at 3%. The survey expected 3.1. When we look at the components, important changes. Services, which includes rent, have now been dropping for several months. We got reduction in commodities, but not that much. We've had energy prices coming down, that's gasoline, and food prices coming down. So CPI in the US a little bit better. Let's look at PPI, Producer Price Index. Well, this is a significant shift. The data came in this week, up 2.4%. The survey had it up 2.6, came in weaker than expected. The prior was 2.8, and that was revised down. So we've seen producer inflation coming down. So consumer inflation, producer inflation, both coming lower. In Canada, when we look at the CPI data, it came in at 2.8% today. That was lower than expected, moving nicely down toward that 2% level. And on the other side, housing starts came in strong. Expectation was for 220,000 new home starts, came in at 281,000. So the economy continues to be pretty strong, even though inflation is starting to come out. And that's the best case scenario for some of the types of sectors and themes that we're focused in. Now, we don't own everything. We're trying to be targeted. Our portfolio is made up of a top-down view, my macro view as to all the neighborhoods we could focus in, which neighborhoods have the best risk reward, and then trying to find specific securities to populate that view in the portfolio, looking at a broad number of securities, looking for specific securities that have financial characteristics that are good but getting better, where we're seeing under acceleration in the underlying fundamentals, and prices that would support the view. So we can find areas of the market that are showing leadership and securities within those groups acting better than the rest on a relative basis. This is where our portfolio should live. The third piece is a very disciplined selling strategy. If you come on this webcast 1 week and one of our core groups starts to break down technically, you can imagine that we'll be using our stop losses to move our way out of those positions. So we go day by day. The top-down work is driven by our belief that in a healthy market over time, the percentage of stocks in uptrends should steadily be expanding. That's a healthy market, expanding breadth, more and more participation. Now, when breadth starts to narrow, often the leading stocks continue on carrying the index higher, which is why we don't want to stare at an index. Because if fewer and fewer stocks are carrying the day, it means the ice is getting thinner under our feet. And it means we got to get more cautious. So this helps us to get cautious at a time when markets still look okay, and get prepared to put money to work when it makes you feel uncomfortable. But we see positive change taking place internally in the market. And this way, it helps us to recognize change before it's obvious in the index or in the prices of ETFs we all watch in the market. So let's talk about that a little bit. As it was a week ago, most of our short-term indicators were positive, and the percent of stocks in uptrends had been expanding. Fast forward another week. Now, only one short-term indicator is cautious, percent of stocks with positive momentum. It means some stocks are resting. They're not moving higher. They're not moving lower. They just lost upward momentum. Percent of stocks making new highs versus new lows, which was red last week, is green this week. And breadth overall is slightly improved. Let's talk about leadership. At the end of May, it was a mixed bag. When we look at this chart, the way we read it, it's a distribution curve. Sectors that have a high percentage of stocks participating in the market would be at this end. Sectors that have a low percentage of stocks in uptrends would be at this end. If we're in capital letters, it means that breadth is expanding. If we're in small letters, it means that breadth is contracting. The average sector in May the 26th had 35% of stocks in uptrends. As of a week ago, we noted a number of key economically sensitive groups had shown some significant improvement, and breadth had improved from 35% to 43%. If we fast forward another week, we're now at 48%. So breadth continues to expand. The strongest, most economically sensitive groups, those that we would call early cyclical, machinery, aerospace, builders, semiconductors, steel, Capital markets and Wall Street, insurance, auto, leisure. These are economically sensitive groups. They're showing the most strength. So the market generally gets it right. There's a lot of smart people. We do not have a corner on good ideas, but we want to understand what investors are doing, not what they're saying, but what they're doing. Let's look at leadership. Well, technology continues to lead. This is the large cap ETF for technology stocks, trading better than 90% of companies in the S&P over the last 52 weeks, has been improving since the beginning of January. And as you know, we came into January with no technology after having watched a 30% decline in the technology sector. As we sit today, we have a broad cross-section of large cap tech stocks addressing things like AI and e-commerce and cybersecurity. These are world-beating companies that trade at world-beating prices. We recognize that, but we have stop losses under all of them, and they continue to churn along. But outside of tech, other groups really have started to come along. Diversified industrial companies bottomed in July and retested the low in October and have been improving ever since. This includes transports. It includes machinery companies. It includes aerospace and defense. A lot of subgroups. Ingersoll Rand is a great example. We highlighted this a little while ago, but it just continues to chug along. You know, this is a construction equipment. With the infrastructure bill in the US, there's a lot of money getting spent on infrastructure, and the construction industries are extremely busy. This company has had really good earnings growth. It's had very strong relative strength. This blue line showing relative strength versus the S&P. It's been outperforming since June of 2021, trading better than 90% of the companies in the S&P and made new 52-week highs as of today. Fitting Equipment, a company we talked about 3 weeks ago, is just chugging along, trading better than 92% of companies in the S&P. These don't look very recessionary. They certainly looks as though the end markets that they sell into, construction and resources, have pretty good demand. This is a company with a 2.5% dividend that is growing high single digits. And they're the distributor for Caterpillar equipment in Canada and a lot of South America. Transport took out and went to a 52-week high in the last week. We talked about some of the rails. We've talked about some of the logistics companies continuing strong. Home builders. Those home building new home starts was a very strong number today. And despite the fact interest rates have moved up as much as they have, new home construction continues to expand in the US. Again, making 52-week highs as a group. This is construction materials and home builders. We've talked about D.H. Horton, new 52-week highs. We've talked about Lennar. These are the builders. And we continue to add in this group as we add to strength. Sherwin-Williams is one of our newest positions, which of course makes paint and coatings. Companies had a very, very steady growth rate. They'll grow their earnings this year. Next year, likely grow their earnings 15%. They've grown their dividend 18% a year over the last 5 years. Fits into our dividend growth theme, and people continue to maintain their properties because there's high value on their balance sheets. Materials. Since June the 1st, the materials group is up 15.6%. That's a significant move. If we thought we were headed into recession, it is unlikely that that would be the case. Cameco, which we talked about today, closed at a new 52-week high, better than 88% of companies in the S&P. Their uranium group is only just starting to break out after a multi-year bear market that dates back to 2014. The leader should be the first one to break out, and then generally will be the one that continues to lead. But if this group is just getting going after the consolidation that's taken place through the course of the Fed's tightening cycle, you can bet it likely performs well as the group continues to strengthen. Vulcan Materials makes aggregates. They have asphalt facilities, concrete facilities. If there's building taking place, they're going to benefit. They have over 400 active aggregates production facilities. They tend to be local because you don't want to ship this stuff too far. but again, trading better than 91% of companies in the S&P 500. There's a lot of great companies, and we don't have to have all our money in the 7 companies that people can rhyme off in their sleep. There's other things to do, and in a reflationary environment, things like infrastructure, construction materials, industrial companies, machinery companies can do pretty well. We know that we've moved likely from a unipolar world where everybody wants to follow the US dollar to a multipolar world, which we are competing against China and Russia and Iran and Brazil. We're going to need to bring manufacturing capacity back to North America, and that's going to require a lot of building. So infrastructure construction companies, this is the ETF grid. This is the beginning of the bear market. We're trading well above where we were at the beginning of the bear market, and this group grinding higher. Steel, a long bear market from 2012 through 2021 resolved. Steel companies' share prices held up the entire way through the Fed's tightening cycle and now threatening to go to all-time highs. So lots of great companies in this cohort, and these are companies that we have across portfolios. Some of them there for capital growth, some of them there for dividend growth, all of them there for total return. Move on to energy. 3 weeks ago, we said that the natural gas producers looked as though they were about to start moving out of the consolidation they've been in over the last 12 months. That continued this week. Oil and gas services. This is an ETF that owns oil and gas services companies. Our biggest is the granddaddy of them all, Schlumberger. It's the most globally exposed. They have provide services around the world. Non-US operations are just about 85% of their revenues. Trades at a reasonable multiple, pays a 1.7% yield, and one that is likely to grow over time. Shawcor is a Canadian company, which many people may know or may not know. They supply pipe into the pipeline systems that allow for building more capacity to move natural gas and oil, and certainly lots of demand there, trading better than 90% of companies in the S&P. So again, a broad range of companies with great financial characteristics, good getting better, prices acting as they should be if things are going well. Just the last few indicators that give us reason to be positive. Consumer discretionary as a sector relative to consumer staples, offense versus defense, today made a new 52-week relative high. Financials, a group that has been problematic over the course of the year, looking a lot like some of the other sectors we've looked at over the last few weeks, getting close to breaking out of its consolidation. But the leading stock, JP Morgan, clearly did about 3 weeks ago. For banks, when interest rates go up, that generally is beneficial, but it takes a long time for loans to reset to higher yields, and net interest margins take time to come along. We should start seeing that in this reporting period. Transports relative to utilities, again, offense versus defense, making new highs. Dividend growth as a theme relative to bond proxies or high dividend payers, making new relative highs. So our holdings aren't changing much. We have a significant, sizable weight in large cap information technology, although it's a slightly underweight. We don't feel we have to have 30% of our portfolio in technology because we see strength in other places, insurance in particular and financials. It's an overweight versus the S&P. Industrials, a significant overweight versus the S&P. Corporate bonds and short-term government bonds, these are largely in our balanced accounts where we need to have a minimum of 25% in fixed income, but they tend to be short-term by nature. Consumer discretionary is still an underweight, although we're bringing it up as the consumer seems to continue to be resilient. Energy, a significant overweight. Materials, we said last week, should they start to break out, we'd add to our weight. We're at 5% versus 2.5% in the S&P, about a double weight. The defensive sectors, we are less interested in. We're an underweight in healthcare, an underweight in communication services, an underweight in staples, an underweight in real estate, and an underweight in utilities. These groups are all expensive. They're acting poorly relative to the S&P. And my guess is if people start looking to the next economic cycle, these are not the groups they're going to add holdings to. They'll use them as a source of cash. Last couple of points. Volatility continues to work its way lower. Market does not appear at this point to be concerned about some near-term economic problem, and we watch it every day. Credit spreads continue to improve, meaning that bond investors are looking for less premium. And interestingly, the stampede into treasury bills over the last year, and there's no other way to look at it, it's a stampede, has started to slow down, but yet to reverse. So where is the money going to come from to move prices higher? Well, likely it's going to come from T-bills. Likely it's going to come from the mountain of money in money market funds. It can come from the mountain of money that's been moved into bonds as a place for safekeeping, and the money that's gone into defensive sectors that is not performing well and ultimately likely again winds up as a source of cash. The reason that we're positioned the way that we are is we know that what comes after a cyclical bear market is a cyclical bull market that goes on for 2 to 4 years. If we get into the right groups and we have the kind of tailwind that you get after a structural bear market, and trust me, I know they're frustrating, then we have a great opportunity to make returns. If our breadthwork starts to deteriorate and give us cause to be more cautious, we have no problem going to cash. We've done that many times in the past. But as it sits right now, we continue to make small adjustments and we continue to work our way forward. So if there's any questions, certainly happy to answer them. This is sort of the formal part of the discussion. Let me just go back because I don't have a moderator today. Let's check and see what questions we may have. Q&A. So the first question is from Lawrence. Lawrence is asking, with so many equities reaching new highs, is it sensible to be a buyer now? So Lawrence, that's a great question. This is the problem that when a group makes a new high after underperforming for a long period of time, that's a good thing. It means that anybody who's been a buyer over the previous number of years is finally happy and making money. They're not in a hurry to become a seller. When stocks made their first new high in 2013, after not making a new high since 1999, it wasn't that stocks were expensive. It meant a new bull market was underway. So we're not looking at all stocks being equal. You know, are tech stocks expensive? Yeah, they're probably expensive. Can they continue to go higher? Psychology is a funny thing. You know, they can go higher for a while. But in some of the groups that we're focused in, this is only just beginning. There's all kinds of people who have pulled lots of money out of this market over the last 3 years. I understand it's been a confusing period of time. If I was an investment manager and I was sitting on a lot of cash and I had no returns coming, I would start to be nervous because the market doesn't look like it's pulling back. And I'm sure we will have pullbacks. The reason that we tried to be invested when our breadth models turned higher, from May 31st to now, I think our macro portfolio is up about 15%. And there's still lots of things to worry about, but you can't wait until all of those things go away. So my belief is that in the right themes, things like industrials, things like materials, things like financials, there's lots of opportunity. And I think that the characteristic I'd be looking for are companies that have an innate ability to, because of growing cash flows, grow their dividends. I think a lot of people are going to be moving away from fixed income to dividend growth as a strategy in a world of rising rates. Okay, next question. Thank you for these webinars. Oh, that's just a very nice comment. Thank you, Sebastian. Anonymous. Now favor natural gas. What factors do you consider when selecting a company? Liquid rich, dry, position for LNG terminals, export to the US, or other factors? At the end of the day, they're all different. We're looking for reserves. We're looking for cost to get it out of the ground. We're looking for proximity to transportation. We've got a lot of new transportation coming, which is going to help. So I think having an ability to get it out to the LNG terminals is an important one. So we have a number of companies in the space. We own them for different reasons. The common backdrop is the sector that they're in and the fact that they are under-owned and unloved. In many cases, there's some great dividends to be had. Companies have paid down debt. The industry is consolidated into a small number of players, so it's less fractionalized. And ultimately, while I know that for a lot of investors, energy is not an attractive place to be, we need energy. And these companies are going to make a lot of money. And so it's not our job to say you should or you shouldn't. Our job is to try and generate a return for investors. And so we are investors in clean energy, but we're also invested in the gas producers and oil producers and the service companies as a whole. If you want to talk about that more, certainly, reach out. I guess just to finish up, I want to thank everybody for tuning in. Again, I know people get shy on these calls for clients. Thank you for your patience over the last, 18 months. Has been a difficult market. We're very, very happy to see things evolve the way they're evolving. I think that we're positioned the right way. If you've got questions, want to have a conversation, reach out either by email or by phone. We're doing a lot of meetings. If you're not a client, you got questions, same thing, reach out. We're happy to have conversations. We take care of about 300 families. It's not a giant number. Great relationships with all of them. We appreciate you taking the time to watch this webcast. So thanks very much. And we'll see you all again next week. Thanks so much.